with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 8th, 2026. Some shout outs to David and Kathy, Alan, Phil, Roger, my good friend Steve. And how about a big shout out to Hannah? Hannah works at BIG, and we've been in the process of doing a major upgrade on some of our technology and systems. And Hannah's been eyeball deep in there, helping to do a really heavy lift and make it happen. Real big job, but you got people like Hannah, it makes it a lot easier. So big shout out to her. Speaking of heavy lifts, what did the market do this week? Well, it pulled off a heavy lift. Dow Jones, not so much. The Dow Jones was up 0.2%, but the S&P 500 up 2.3% on the week. Starting to catch up to us. You got to keep on going there, S&P. You're going to catch up to us in a little bit if you keep moving like that. NASDAQ Composite up 4.5%. The Russell Small Cap Index up 1.7%. So all the major indices up, three of them up quite a bit. Volatility Index was also up a little bit on the week. So markets rising along with the VIX. That's something that catches my attention, okay? When the Volatility Index is rising along with the market, again, I think that's a little bit of a warning sign, short-term warning sign. Long-term bonds, as measured by the TLT, they even got on the action. They were up also, up 0.55% on the week. Gold was up 2.5% and silver up 6.9%. So a really pretty good week all across the board. Sounds like sunshine and lollipops, but not really. Or is it, I should say. Listen to this for just a moment. The S&P 500, lock this in your brain now. The S&P 500 was up 2.3% on the week. Okay, you got that. Now listen to this. I'm going to go through the sectors. Energy, down 5.3. Materials, up 0.4. Industrials, up 0.14. Consumer discretionary, up 1.3. Oh, now we're getting somewhere. Staples, flat on the week. I've not heard anything over 2% yet. Have you? No, I didn't think so. Healthcare, negative 1.1%. Financials, negative 1.3%. Communication services, your internet stocks, flat, 0.19% on the week. Utilities, negative, down 3.93% this week. And real estate, up 0.2%. Now wait for it. Here's the kicker. Technology up 8.4% on the week, driven mainly by semiconductors, which were up 11.1% on the week. So listen, there you got an S&P 500 that made 2.3% on the week, and no other sector got close to it. The rest of the market was just treading water all week. It was all driven by a very small cohort of stocks, mainly related to AI and semiconductor chips. Now, that said, we've got semiconductors. I'm very happy that we have plenty of exposure there to AI and semis. Global Foundries, we've got that in our models, up 14.7% on the week. We had Marvell in our aggressive models. It was up 3%, but it's up like 71% quarter to date. Marvell, it's up 100% year to date. And then AMD up 28.4% on the week. And, that brings me to a topic of conversation I want to have. I had someone reach out to me this week because, remember last week on the podcast, I mentioned that we are going to be the blue fish in Finding Nemo, right? Dory. And that song she sang, keep on swimming, 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 swimming. We're going to keep on trimming, trimming. That is what we're going to do in this market because that's where my conviction lies. I think that things look constructive, absolutely, but things also look expensive. And I don't think, it takes much to send this thing the other way at any given time. With all of that said, we have had a mind to trim big movers, right? So someone reached out to me this week because on Tuesday, I decided to trim AMD. Okay, they were going to report earnings Tuesday night. And I told our team, I said, look, guys, we just trimmed this stock on February 2nd. Now, let me just back up for just a moment. Going all the way back to last year, we bought some AMD last January for like $116. We trimmed that this February, all right, this February, 1 year later, for $246, up over 100%. AMD went from $246 in February to up over $350 as of Tuesday, up like 60% in 1 month. Now look, last March 4th, we backed up the truck and we loaded up on AMD, making it our largest position. We paid $97 for it, $97, March 4th of last year. On Tuesday, it was over $350 a share. I told my team, I said, look, this stock could very easily be up 20% tomorrow after they report earnings, but it could also very easily be down 20% after they report earnings. And I said, we need to trim it. I said, it's going to be disappointing if they have a great quarter, but some of this could be priced in. This is the prudent thing to do. And that leads me to something. Like I got to tell you, folks, I don't use the F word on this show. It's a family-friendly show. It's a clean program. I try to talk well. I try not to use words like that, but I have to tell you, I never use the F word on this show, but I'm using it today. I got to use the F word today because it's the only way I can drive the point home. And that is this. We are a fiduciary, okay? And not the F word you were thinking of. Get your head out of the gutter. What is wrong with you folks? Come on now. Fiduciary is the word I'm thinking of. And let me just say something about this. Well, fiduciary is a really big definition. There's a lot to it. But when it comes to just managing the money, a fiduciary is required to manage assets carefully, prudently, and with diligence, okay? So here's the thing when it comes to a stock like AMD. Yeah, we trimmed it. Yeah, the stock was up 28% on the week. A lot of that happened after we trimmed it. And yeah, would I have loved to have just held the whole position and made all that money on all of the shares? Absolutely. Don't you think I was disappointed? Of course I was. But understand something, folks. Stock returns are not arithmetic, okay? Understand this. If you invest $100,000, okay, got $100,000 invested, you make 50%. You are now up to $150,000. Now, next year, you lose 50%. You didn't average 25% a year. You're not up 50% still. No, you made 100, you took up to 150. Now 150 loses 50%. You're down to 75. You're down lower than where you started. You're 25% in the hole. Okay? The same number, 50%, 50% up, 50% down. It puts you in the hole by 25%. My point is this, the prudent thing to do when we have these stocks that are screaming and are going parabolic and going up in straight lines, the prudent thing to do is to trim them. Now, that doesn't mean we sell the whole position. We just trimmed it. And guess what? I've done this with AMD on 4 different occasions over the last 5, almost 6 years now. We originally bought the stock at 67. We sold some at 130, and guess what? It dropped all the way back down, 50% down to 67. And then it went up to 130 again. We did it again. And then we bought some at $90 some a share. And then it went up to over 200 and we sold half. And then it went back down to 97 last March and we gobbled it up. And we just trimmed it back again. Now, we've done that multiple times over the last few years. Did we have to do that? No. We could have bought it at 67 and we could have sat on it this whole entire time. And we would have made, I guess, the same amount of money, really, in the whole scheme of things. But here's the problem that I run into. When the stock drops 50%, you don't like it. See? If you were okay with that, I'd be okay with that, but you're not. We have this little bit of a rub here, this little bit of a friction where you want to make money, but you all don't like to lose it. See, if my job was just to make you the most money I could possibly make you, and that was it, right? That was my only job. Make me the most money you can, David. Well, doggone it, I would have never sold the stock. I've always believed in it. That's why I've never sold it completely. I've only trimmed it back over and over again. I've never sold the whole position because I absolutely believe in Lisa Su. I absolutely believe in the company, okay? But if my job was just to make you the most money possible, I probably would have never sold the stock. And it would have dropped 50% on 3 or 4 different occasions over the last 5 years. And you would have ridden that roller coaster every single time. Problem is, just about all of you, except for a handful, I got 3 or 4 clients who are an aggressive model of our entire practice. A handful of you are okay with that. Most of you are not. You don't like to see the losses. You don't like to get smacked in the face by the stock market. That's why we do what we do. So I hope you have some understanding there, because I know the dude that reached out and asked about it, not the only one tracking, a lot of you do too. I just want you to understand what our thought process is, okay? When you have a big gain, when you have a parabolic move, when you have a bifurcating event. I mean, look, this is just going to be one or the other, right? It's going to be a good quarter or a bad quarter. It's going to be a good announcement or a bad announcement. It's going to be up 20 or down 20. Remember, the down 20 stings a lot worse than the up 20. It stings much, much worse. That 150,000 loses 50%, you're down to 75. Remember, you started with 100. So it's important that we manage the downside of things. And that's why we do what we do. So what else did we do this week? We added money to bonds, okay? Jeffrey Gunlock and the Double Line Opportunistic Bond Fund. I talk to Jeffrey every now and then. Sharp guy. You'll see him on CNBC from time to time. He's got a great fund, and we've got a big position in it. Well, bonds have kind of sold off a bit here over the last couple of weeks. Since April 20th, down. They've been dropping. And they really look like they were washed out here this week. They hit a buy signal on some of the technical charts. So I decided to add some money to that. Other than that, we're just kind of holding tight. Look, the S&P 500 hit some big levels on the technicals this week. Some technicals that suggest maybe short-term exhaustion. We're getting to the end of earnings season. We're going to be left with nothing really but headlines coming out over, you name it, Fed chair or war in Iran or oil prices or et cetera. So I think right now it's good to kind of hold tight, keep the positioning that we've got. Listen, when the war in Iran came out and the market took a hit, it was down like 8% on the year. The average decline in a midterm election year is 19%. We got nowhere close to that, right? Nowhere close. So I just don't trust what may or may not happen in the coming months. I think we want to maintain a cautiously optimistic outlook and reflect that with our positioning. And that is what we're doing. We got some money in different places where if the market gives us a great opportunity to buy, we will buy it. But other than that, I like how we are managing money this year. We're just covering all of our bases. I think that's the wise thing to do. So look, I know I went off kind of into the weeds this week, but it's important. If someone reaches out, they got concerns. He's not the only one. I know others of you have it too. So I figured, you know what? Let's take this. Let's just throw the F word around a little bit and have a good time this week and talk a little bit about how we manage money, what prudent means when it comes to taking profits off the table. It doesn't mean we sell out, but it does mean that you should trim back from time to time, lock that profit down because nobody ever got hurt taking a profit, right? I'd much rather make 20% on half the position than to lose 20% on the full position. So look, I'm going to go and wrap up. Between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe is buy a brand new Tesla, Steve, or a brand new Ninja Creamy. I mean, look, I think that is a really good option in lieu of. I mean, seriously. No, I'm just kidding. Hey, maybe it's buy a second house, retire a little early. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.